I'm super excited to introduce the next panel today. It's quite the stacked panel. The title of the talk is going to be Institutional Crypto Stack, Custody, Clearing, and Execution at Scale. So I'm very pleased to introduce the moderator today, which is Caroline Malcolm. If you want to come on out, guys, give him a round of applause.
It is wonderful to be here, and we have a really exciting conversation coming up, which is really about these two worlds, crypto and traditional finance, coming together, but not so much thinking about perhaps the market side, but thinking about the infrastructure stack that sits behind that, particularly around custody, clearing, and settlement. So I'm Caroline Malcolm, Executive in Residence at Global Digital Finance, and we have got a very kind of interesting composite from the sector on the panel for discussion today. I will introduce them as I turn to them for each of the questions. We only have 40 minutes, so we have a lot to cover, and we've got some people very well placed to share their expertise. We're going to dive right in, and I really want to take the first question of what's wrong with the way that institutions are building blockchain infrastructure today. So thinking about this very much in the perspective of, if you were a traditional financial institution starting from scratch today and thinking about how to integrate blockchain-based infrastructure, where would you be that we aren't at today? And maybe, Eva, I will hand over to you, Eva Lawrence, Head of Revenue for Figment.
Thank you. Thank you very much. Great to be here today. I think there are a couple of things that institutions perhaps falter on when they're looking at starting their crypto journey, building blockchain-related products. The first one would be that they have fragmented teams internally. So sometimes the problems start off internally. They have 5 different teams, each working in a silo, looking at a different sandbox, a different project, and a lack of communication between those teams. So I'd say, internal coordination of those institutions is number one. And then secondly, over-indexing on a build strategy versus a buy strategy. Well, we can talk about that a bit later, but feeling a need that they have to build everything in-house and shying away from partnerships is the second one. And thirdly, I would say a perhaps misconception that all blockchains are created equal, are exactly the same. And so if you build on one, then, well, you can just replicate that over to the other, which obviously doesn't work. There are nuances to every network, and there are complexities around, reporting, governance, if you're talking about staking, in terms of rewards, of a lockup period. So I think that the final one that is key is just understanding those nuances. And if you don't understand those nuances, work with someone who does and who can explain the difference to you. So that's collaborating internally and having cohesion internally, not shying away from buying and partnerships, and understanding the nuances on different networks. They're the top 3 issues that we see.
Thanks, Eva. Antonio, you probably bring a slightly different perspective because you're the Chief Data Officer at Euroclear. Could you share what your experience has been kind of bringing the institution along to the world of crypto blockchain?
So happy to be here. So I'm actually the Chief Digital Officer of Euroclear, so not data, but that's more or less the same. So I would say I recognize all that Eva has said, but I think we also, because we are aware, we're working on it. And we're going to come back later. I think the first thing I would say when you want to work with large institutions is patience. Yes, we are complex. Yes, things are long. Yes, we have very particular processes which are very often tailored not to collaborate with fintechs, because when you are a very large company, you have expectations and your regulators have so. I think what is changing over the last 3 or 4 years is the way we figure out the role we want to play, we also become better partners, and we are getting more comfortable on finding counterparties that understand our constraints and begin to walk our language, understand what we want to do. So I think it's getting better, and I think that the flip side of the way you asked the question, so I think what's going right also is that institutions understand that they have to partner, because we can't invent everything, and there are other people out there, most of them around the room, that bring knowledge and expertise that we don't. So I think that the trend is changing. I see much more of a co-creation opportunity where you can share what you want to do with counterparties that also understand. But being patient and trying to walk and talk our language is key for us to get a common way to work with each other.
Antonio, just on that, how much do you see it being sort of more effectively sort of top-down driven, or kind of coming from the bottom up in terms of driving these kind of initiatives forward? Do you need the top-down support to actually kind of get things underway?
I think you need a bit of both. For instance, you have my example. So I have a background. Actually, I created fintechs, I operated. So I understand, like, when you oversell something, of course it's ready when it's not, and those kind of things. But you also need people internally that get comfortable, because it gets the conversation around. So I don't think it's one or the other. In order to be really efficient, you need both. You need top management support to understand that you don't work with a company which is going up or scaling in a new environment like an established player. And you need people internally that get the others comfortable, because they educate the organization to work with. So it's a good combination, a good recipe is when you have both. Top management support to ease the pain and kind of nudge things forward, and then people that take the ball forward and make the organization comfortable to operate with a different company.
Okay, that's helpful, and probably differentiates you really from the kind of crypto native experience in that regard. Declan, VP and head of Linear at Consensys, could you share like where you see organizations going wrong as they try and make this kind of transition journey? And do you think it's a journey that's going to sort of continue to happen in this incremental way, or be something that we see actually kind of reach a sort of tipping point, and then kind of it's all kind of all assets on chain and it's ready to go?
I think the biggest sort of anti-pattern I see today is the belief that you should still have your own sort of private permission layer 1 blockchain. And the reason for that is that the technology has now evolved with zero knowledge proofs, with advances in consensus mechanisms, that you can basically take your chain as a bank, as a CSD, as an institution, and you can privately connect it to every other one and Ethereum, whilst keeping scalability, whilst keeping privacy, whilst keeping compliance. So you basically get the best of both worlds. And I think the key thing I would want people to take away is you can now have your cake and eat it. So you keep your own walled garden, but you can also talk to everyone else, much like the internet, right? We're kind of recreating the internet here, but focused around financial services. And I think will financial institutions rip and replace, or will it happen incremental? I think it has to be incremental. I think realistically, these systems work in parallel, so you actually can show that on-chain, the settlement is happening, the smart contracts are working, the systems, off-chain are like mirroring this, and then they're showing it as well. And eventually we'll get to a place of regulation when they'll say, right, on-chain finality is actually legal finality. We can recognize smart contracts legally, and then we can sort of do a big transition from this like hybrid migration path.
No, and I think, as you say, as much as we've advanced on the regulatory front over the last decade, there's still some questions like this question of finality and getting to a level of comfort, or even things like sort of tax treatment of different assets on the tokenized version versus the kind of traditional version, I think, are still yet to be solved. We had a nice mention there of Ethereum. So Matthew, that's my cue to turn to you, enterprise lead at the Ethereum Foundation, to kind of think about, I guess, from your perspective, working with partners, for those in the room, what would be your kind of takeaway of the thing that they should think about differently that you see most firms not thinking about, but you wish they would?
Yeah, honestly, Declan nailed it. So I would have said something very similar to that. Like, just looking at the trajectory of institutional adoption kind of shows you the direction of play, and institutions have been experimenting with digital assets, ledgers, and blockchains for over a decade, and it all started with private chains and is clearly moving to a public chain. But Declan explained why that is possible. But why would you want to have private execution on top of public blockchain? it's not just for the accessibility to global markets, interoperability, and transparency that we're familiar with, but that technical implementation actually leads to kind of operational resilience from a technical perspective. So the uptime of Ethereum, decentralization, resilience, security can all be inherited by the institution while still having the compliance needs that they need. And so that's something that I think we spend time doing, trying to make them comfortable with that, and really presenting that as a viable option for them when it comes to having their own block space.
Tero, do you want to share from the perspective of Paxos, so again, like quite a different player in this ecosystem that we've just been talking about? From your perspective, is there anything to add to what the others have mentioned on this issue?
This has been a very good discussion, and let me just phrase this more from a journey of this topic as a journey. So it's basically the tier one banks are going through the same journey as the blockchain world, going from very much a monolithic solutions to point solution, and now with regulatory clarity, bringing the platforms, especially modular platforms. So essentially, just what our key point would be here to take a strategic view from the tier one bank point of view on the how you approach this. These are not technical proof of concepts anymore. You need to involve from day one your compliance, your risk, your markets, your operations, and essentially avoid anything that is closed.
Thanks, Tero.
Do you mind just if I just add something to reacting to one of the points? I think because it came across like, is this a transition or more a coexistence of? I think the way we look at it is probably more a coexistence of different solutions which are going to find their path. So the same way the internet didn't replace the movies or the radio, TV, things tend to find their way and their place. We also think technology and the solutions are going to somehow find a place. I don't have a crystal ball, so don't ask me the answer about exactly how. But I think it's certain these things are going to find a way to be relevant as such, be it within traditional finance or DeFi or within these platforms. Yeah. They will find a way. Probably there are way too many today, but in the end, a number of them will survive in a more of a coexistence of systems, which is relatively complex to operate than one replacing fundamentally the other, which I think we were trending to.
Yeah, and look, I mean, it'd be good to get your perspective on that, Tero, because I think in my conversations with traditional finance, I mean, at the moment, they really feel like they're bearing this kind of like cost and it's worth the investment because that's where the market's going. But at the moment, and it's like, kind of very questionable whether this kind of the cost justify if we continue to have this kind of two-track system for, beyond the sort of next 5 or 10 years. But Tero, what's your perspective on that?
Yeah, just to add to what was said previously, let's not think about coexistence of doing something on a new way. Just doing something on blockchain usually doesn't add value. What we need to look at the new business models, what it enables. Essentially, just a very quick, just a simple example on this is real-time settlement, 24/7 availability of funds. It's pretty much the same analogy as happened with instant payments in the EU area. But instead of just where banks ended up in just looking at instead of looking at this as a payments exercise, it very much faster came to an exercise where you involve cash management, liquidity. So essentially, this is something that will enable you to rethink everything and also make sure that you don't just try to do the same thing on a new platform.
I think Tero has actually the right point. Is you still do settlement in a much better way. The same today, you access your accounts in a much better way in a mobile than going to a bank or an ATM. I think coexisting of the economical value is an opportunity to do better. And we think that we see a lot of opportunities in a lot of domains to continue to deliver the same economical value, but in a very different way, much more added value, because what the technology enables tomorrow.
Yeah. So one area, and it's interesting you touch on this, that we think about which may not be more efficient under this kind of DLT-based markets, is this idea of hypothecation, rehypothecation, and really thinking about when we would traditionally use client assets to generate yield and fund operations, on-chain custody makes that structurally more difficult Do you see, I guess, programmable custody sort of evolving to recreate those kind of mechanisms which make it as capital efficient? Or are we simply going to accept a sort of a higher capital drag that will make up inefficiencies in other areas? And I think it's interesting because I feel like we've just gotten rid of some of the regulatory capital drag that we've seen in the blockchain space, with a number of countries stepping back from the BCBS's rules. And I think ultimately they're going to have to revise those rules. But now we're seeing the technology itself, it's not all kind of sunshine and rainbows when we make this transition. Matthew, I know you have some thoughts on this. Do you want to jump in?
Yeah, I think there's certainly custody considerations around what does it mean from a custody perspective if I deposit in a Morpho, for instance. But I think, well, we are working through that now. Financial institutions are working through that. So as that's resolved, I think actually there's a lot of opportunity for increased capital efficiency. So really what you'll see is, of course, fundamentally these assets are composable, so it can be used across DeFi and across different systems. So I think really actually can build significant rehypothecation or efficiency, but when built correctly, you now get that, but with the added benefit of transparency. Or if you need privacy, you can use zero-knowledge proofs to kind of wrap that in kind of some sort of governance system. So the capital efficiency there, I think, can actually unlock a lot more. And that's before you even look at programmability of the assets, particularly with a move. I know everyone's excited about agentic payments. And when you have the ability to quickly move from a yield-bearing instrument to a stable coin and consistently be kind of doing treasury management or reusing assets, I would actually see us getting to a point where there's an increase in capital efficiency.
So I think this is interesting because I can sort of see how you make that argument, but it seems like we also are going to need some infrastructure to be able to actually monitor the sort of risk distribution that comes out of the kind of this increased rehypothecation that you've just proposed, both from a firm side but also from the regulatory side. And do you think that infrastructure of being able to monitor where risk is in a very real-time sense based off on-chain data, does that exist, or is that, and who should be thinking about building that? Do you see that as a responsibility of the regulator side, or firms also are going to be needing to think about having that visibility on their whole kind of like book?
We have kind of already a quite mature, but not in the traditional sense, ecosystem of curators, risk curators, vault infrastructure. But we'll also see, incredibly talented, experienced traditional asset managers, investment managers coming in and managing their portfolios on chain. They bring with them an absolute wealth of risk management practices. When you couple that with the transparency and access to data in real time, which is verifiable, which is not opaque when structured correctly, I think that we also get to a position of greater risk management. Are we there right now? No, I think it's also just because it's permissionless. There's lots of aspects of the system are permissionless. Doesn't mean that there shouldn't be guardrails to protect users, just like we have in traditional world. But the tools are certainly there and being built towards.
I'd love to dive in a bit more to the kind of guardrails point, but I know that kind of time probably doesn't permit that. Just before I go on to the next question, any of the others want to jump in on this question of the sort of the future of custody and rehypothecation and the infrastructure that we still need to build out to get to that place? No, all right, they've left it with you, Matthew, I'm afraid. And this next question I think is a little bit kind of funny, and I think we probably wouldn't have been having this discussion 8 years ago, which is really around, the dream that we were sold is this kind of the world without intermediaries. And yet the reality is that what we're seeing is that there are, in fact, intermediaries in this world. And Eva, I'd love your view on who are the intermediaries of the future and what is the business model? Because having just spoken about custody, we have seen a massive change from that being a kind of a value-adding service to really just being quite commodified at this point. If we throw ourselves out sort of 2-3 years, who's going to be making money and how are they going to be doing it in the kind of stack?
So the intermediaries of the future really are the ones who own the customer relationship and have the value to add there. And also those who are able to intersect with regulated institutions in whatever form that could be. Whether it's custody, whether it's staking, whether it's trading at exchange level, those who can own that customer relationship directly with a regulated institution is the ones that will see the most success in the future. I do hope that we are streamlining our intermediaries going forward, right? We don't need necessarily one for every function, but I think that will happen with time. And I think what has been interesting is also looking at which levels of the institutional stack or the infrastructure stack that entities have been focused on, right? The journey goes from custody first, understanding where will I hold my assets and who they'll work with for that, or will they build their own. Then generally the progression is trading, settlement, then on to staking and yield. And then finally, we've seen that go to just a simple validator provider, looking at corporate chains and which infrastructure provider they will work with to, help with transaction monitoring and settling transactions on corporate payment chains, things like that. So I think we'll continue to see that evolution of intermediaries, but some consolidation as well, with the kings for the future being those that actually own the client relationship.
So I think that's a really interesting point and comes up sort of time and time again, who owns the customer relationship? And from afar, you would think that the traditional financial institutions are extremely well placed because they have those distribution networks in place. But Tero, is that the right assumption?
I think it is. When we look at Europe, the fintechs haven't been taking over the market as they have been in the US, for example. And in many cases, the banks are the ones that have the best customer contact. However, the challenge, especially for the tier one banks, are that especially the younger customers are moving towards the more relatively younger, for example, in our case, on-chain players. However, they do have something every customer needs. They need to have the bank accounts, they have the payment setups and so on. And this is something where banks can play and differentiate. Keep the customers, keep hold of the customers, and work with players who don't want to own your end customers.
And I think that really, you've really kind of shone a light on why the discussion now around stablecoin issues is so critical to this question of the future, because what sort of do we let them be a bank, and what sort of bank do we let them be? Do we let them be a narrow bank, or are you only going to have to do a full banking license with all the regulatory overhead that kind of comes along with that? Antonio, do you have any thoughts on where we're going?
I think that the way you expressed it, I think intermediaries are seen as a negative thing because it's questioning the value it creates. So the way I would frame it is, if the counterparty you are engaged with creates value, they're going to continue to coexist. You'll always need somebody, and I think you're touching base, to give information to make a decision. You always need somebody to execute a transaction. You will need somebody that you trust to all your assets that induce it. It has different names and formats: banks account, paper accounts, custody, wallets. But fundamentally, if you're delivering something that's value, you're going to find a way to be relevant as such. The format, I think, is going to change a lot, and fundamentally, the way to deliver that service, which you can see when using the metaphor of retail banking, younger bankers don't know the idea of going to a branch itself because you're doing it on a mobile. I think the same thing is going to happen in your space at different speeds. There will be more pressure that if you are creating value, you're going to find a way to remain and be relevant. If your value is not enough, you're going to be questioned and challenged on the way you coexist, and that's going to be the decisive point. Are you able to continue to deliver value in a different format, in a different way?
So, I mean, I do take that point, but I would also think that there is a question there too of whether you're going to see more vertical integration in firms, and some of those formerly kind of external intermediaries that you use kind of being brought inside firms as well. Because I think we're definitely seeing that in terms of, on the retail side at least, in terms of horizontal integration, like this bringing together of, you know, crypto, of prediction markets, of tokenized securities, you know, and potentially into sort of agentic payments, and thinking about the ownership of the customer relationship from that perspective, whether we also, you know, the existence of intermediaries is also about whether they remain as these kind of third-party service providers or how much they are built into the businesses.
I think you're right, but I think the way I see it is very often a pendulum cycle. When you want to go fast and you want to be more specified, you want to have dedicated teams and more focused. It's just more of an efficient vehicle. But then you question why it's integrated. And like, for instance, if you're doing wealth management, you want an integrated portfolio view of your risk. So I think it will vary depending on the cultures and the markets. And probably today we are more in a model of concentration or more horizontal. But is it going to be the case in 2-3 years? I think it's going to evolve because these things tend to be cyclical. When you concentrate too much, you dilute, and you have afraid of expertise, and then you focus. When you focus too much, you lose integration. So I don't think there's like one shoe fits all approach. It's a question of cycle and maturity, and I think we are going over that phase as we speak.
Okay. Declan, I want to come to you because I know that you kind of alluded a little bit earlier in your first intervention to this idea of the customer relationship and who's going to own that. Do you want to come in on that, or on this question of sort of integration of intermediaries?
Yeah, I think intermediaries, they won't be replaced, but they'll be transformed, right? Like custodians, they become sort of digital, like signing and key management service providers. Brokers become like smart contract routers. You know, clearing houses just become settlement layers, right? So that's the transformation we're seeing. If you look at the stack, you've got the underlying protocol layer. It's open source, it's credibly neutral, it's in effect commoditized. You've got the application layer, which is going to proliferate, you know, across the different use cases. So I actually think the durable value of the stack is probably in the middleware, right? It's the privacy, it's the identity, it's the compliance. And I think maybe to your point about vertical integration, at least what we're seeing now is actually being able to understand the core underlying technology and then build on top of that in the middle and then deliver that to people who actually know their customers and their use cases. I think that's where I see the most value right now in the sort of the current sort of evolution of the cycle.
I know that's quite interesting that we're going to see security, privacy, sort of the compliance side kind of be more of a value add than perhaps we have seen custody, you know, historically, or settlement and clearing having been historically. And that, I think, probably reflects a little bit shift in the broader technology market as well. Tero, Matthew, do you want to jump in on this, or
I think very quickly, really, fundamentally, I think it's a disintermediating technology, blockchain. But the goal really should be that those that add the most value pass on that value to the end customers. So when you remove service providers that are rent-seeking, who at the moment are just in place to help resolve issues of human error, in reconciliation or whatever it may be, you remove that and you deliver a better product to the end user. So that should be the goal.
I want to come back to something that Eva actually mentioned right at the beginning, which is this question of buying versus building, and how you should really be thinking about how you make that decision, and perhaps even on different elements of the infrastructure stack. So Antonio, I might come to you first.
So I think the way I would phrase that question of framing is you need to focus on what is your value. What are the things going to make a difference? If your job is to create any type of banking product, tech is not your job. Your job is to find the right partner to engage and to create a solution to solve a problem. And because financial institutions are very large IT organizations also, and I have a part of my own IT team, there's a temptation to do it yourself kind of thing as such. Now, as we get more mature and we are actually more used to working with partners, the biggest thing we have to do is actually integration. It's bringing the pieces together to deliver service, whatever that is. And that's a challenging thing to do. What I would advise to people on the other side trying to sell into this organization is, I said patience in the beginning, that's like always number one. Number two is be focused. Be very clear what you're good at. And don't try to be everything for everybody, because when you're a small company, it's very easy to say yes to a large organization. I can do anything and everything. And then you lose focus, you're distracted, you're not efficient, and we don't know where to place you. Are you that? Are you that? Are you also that? And that makes the conversation more difficult because it's already difficult not to fall into the temptation of do it myself. If I have too many choices and things are unclear, it becomes even more difficult. But the one thing you have to always have is patience. Our cycles are different than the fintech cycle, and just the way it goes.
So you've sort of answered the flip side of what I want to turn back on you now, which is you've answered the question of how people can be a good partner to a large traditional institution. But you mentioned before is you also having to rethink about and learn how to be a better partner yourself. What are some of the elements of that you think are important and you've had to learn? And I guess part of that is, do you think the temptation to build is also part of wanting to have that learning and development curve, or it's more about not having trust in the external providers?
There's a lot to unpack. So the short version of that is, I think, we have a lot of very smart people that also want to engage and experiment and discover. So it's very tempting when you have very smart engineers saying, of course I can do this. And the trick is to say, of course we are, but our focus should be on assembling those things to make an even better product rather than to invent every single brick of the solution. I mean, I don't think of building electricity to power my service. However, on some of these services, we fall into the trap of, I can just do anything that they do because it seems to be easy or not. So I think the way I try to say, what is our end focus? What is the thing we get excited about? In our case, is solving a client's problem. Custody, collateral, asset servicing, making world financing better, and requires that I combine all of these solutions. Okay. And that's equally elegant and sophisticated. Yes. But it's always a discussion, a dilemma about, but we could do that. I'm like, yes, we could, but we are not, so because we're going to focus. Yes.
The discipline, really. Okay. Tero, on this question of buy versus build, when you're talking to organizations, what do you find is on their mind and how do you help them think through it?
This is something that always comes up. And there's, of course, for a tier 1 bank, there are compliance requirements of what you have to own and what IPRs you have to have in-house. But the short answer is build where you can differentiate and buy what you can, where you need utility and scale. Essentially, and this comes very much back to what we discussed earlier on for example, the tier 1 banks, the customer relationship, and understanding the customer, serving them, having the contact with them. That's how having the contact with your end customers, that's how companies keep themselves relevant. Then again, on the engine room, there's more room to maneuver, especially scaling is something that's difficult to achieve on the first try. But essentially, from our point of view, we have been working on customers also on a hybrid model where time to value is important to our customers. We take them live with our solutions, and then piece by piece, at their own pace, they start taking over and building replacing our solutions at the pace that fits them. So essentially, that is a business model that works for us because we need to be innovating. And if our customers can do something better than us, we're happy to let them focus on that. But then again, time to value with, for example, our solutions is something our customers do value.
That's really interesting, that idea of kind of you're making yourself obsolete over time so that you can get back to innovating and not just kind of, punching out more cookies from the cookie machine.
Exactly, and that pushes us to innovate and push the boundaries.
Eva, this question on buy versus build, any perspectives from Figment?
Yeah, I think one of the things that some firms consider when they're looking at buy versus build is the risk factor, and they start off by the assumption that it's actually less risky to build in-house, when often what they find out after investigating, especially around staking and staking infrastructure, is actually more risky to build in-house without the right expertise. Now, of course, the same goes to choosing the wrong partner. If you're not working with the right partner, that, of course, is also risky from the buyer perspective. But I think that that the risk analysis is often one that leads firms, especially large banks, large asset managers, to want to partner with a leading firm. And I really like the idea of firms evolving over time and looking to build. And what we also see is occasionally firms looking at partnering with us, but say running some testing and some sandboxes internally as they try to educate the teams, not just theoretically on how staking works, but by actually doing it. So I think there is a key component of education in-house and upskilling in-house as well that's important.
It's interesting you mentioned staking because I can't help thinking about regulation. I think it's just been such a prominent topic in terms of staking, let alone the kind of business side and the kind of technical mechanics. And so I do want to bring us to regulation, which I think has been sort of a little bit on the horizon through this discussion. And kind of just do a final round through the whole group of, you're very focused at this stage, I think, on building and finding value in the ecosystem. Do you think there are still kind of major regulatory blockers in the markets that you work in that you would like to see lifted? And if so, sort of what's top of your wish list in that regard? Either is to remove a blocker or something which, if was introduced, would kind of open up a kind of a new business line or a new opportunity in this space. So perhaps I'll start with you, Matthew.
I can't really speak to specific regulation, but I would say kind of a mindset around when you look at decentralized systems having no single ownership, reframing that as potentially often a positive because you have a lack of centralization risk. I think that's just something that people are clearly becoming more comfortable with, or probably the big reframing that we need to keep working on.
Yeah, that's a great point. And I think, we are slowly seeing a move away from, it has to be a permission system. I think it's greater from very large institutions, standard setters like the Bank for International Settlement, greater acknowledgement that there is a role for permissionless systems, maybe not where the kind of early parts of the industry would like us to be, but I think we are getting there. And I think the model that both you and Declan outlined, where you do have this kind of public permission, best of both worlds systems that can be set up, I think is probably where we're getting to. But that's been very much kind of an education journey. Antonio, regulatory ask.
I think regulation has evolved a lot over the last 18 months in all geographies. And I think the one thing I would call out, particularly in Europe, and it's a very recent change, digital assets becomes eligible to the collateral system. I think that's a signal. The industry is maturing, the ecosystem is getting ready to something. I think we're not very far with everything that's happening, in particular in Europe, having some kind of a playground that we can use actually to scale this industry as such.
Okay, interesting. Tero?
Yeah, I'll be very fast. This is not about something to be unlocked, but something to avoid. We are the only issuer in the world to have multi-jurisdictional issuance for our stablecoins. And that is something, a very heavy topic at the moment. We are regulated in EU and in Singapore, and there's a lot of discussions in these different jurisdictions to essentially deny multi-jurisdictional issuance and multi-jurisdictional compliance. In our view on this is simple. Money is global, on-chain business is global, and gating it more just hurts the ones that raise those gates.
And I think it's a really interesting point. It goes to these questions of reserve, for example, of redemption requirements. And I had the good fortune the other day to spend a lot of time looking at kind of some of the major issuers and, where they do separate issuance of the same type of token in different jurisdictions. And that effort to have very clear demarcation, which I can sort of see from a regulator's perspective, the benefits, but it's a little bit like the challenge we have in Europe with MiCA in terms of being able to access a global order book, and that the trade-offs, and I think often the trade-offs are not brought to the attention of the regulators, that okay, but then your clients will, your consumer base, your citizens will have less liquidity in their markets, and is that really something that you want? Eva, regulatory wish?
I would like to echo that. I mean, I think for me here in Europe, that's what I would like to see is more cross-European collaboration. You just mentioned MiCA. We've all heard of MiCA, but there are nuances to the way certain member states enact the provisions and the guidance of MiCA, and that leads to regulation arbitrage across these member states. So what would be great is if we could see more collaboration from the regulators and the member states in how MiCA and other regulations in the industry are enacted.
Yeah, and I think we're starting to see the cutting edge of that in terms of denial of passporting rights across jurisdictions. So the kind of MiCA European dream really starts to kind of come into question as we get into implementation. Last thoughts, Declan?
My request would be on-chain finality has to be legal finality. It has to be recognized that way. If every CSD transaction, like DTCC, etc., that needs to be the way it's fully recognized, because otherwise we'll always have two parallel systems. And the end game has to be to fully migrate and transition to a world that is completely on-chain for all assets and value.
So there's still a lot of work to do on the regulatory front, despite MiCA and other advances throughout the world. So thank you so much for this discussion. Really appreciated the perspectives on how we might see the kind of institutional crypto stack evolve as we move more into the world of traditional finance. Thank you for joining us. I know the speakers will be available afterwards for you to talk with them more just outside. But a round of applause, please, to the speakers for today.
Welcome to Signal Week.